So what makes the exclusion on the sale of a personal residence one of the best tax benefits that you can get? We'll get into that in a moment. My name is Merrill Taylor. I am a CPA. I specialize in working with business owners and helping them save money on taxes. We've helped them save anywhere from $10,000 per year to hundreds of thousands of dollars per year using niche tax strategies. So today I wanted to talk about the exclusion that you get on the sale of a personal residence. What makes it so good is it just completely eliminates the income and tax on it. There's very little things in the tax code that just make taxes vanish and disappear. And this is one of those. And it's a bit of a cliff, meaning that if you miss this by a day, it goes away completely. So the way that the rule works is that if you use a residence as your personal residence for 2 out of 5 years, and you sell that residence for a gain, if you're single, you can exclude up to $250,000 of that gain. If you're married, filing a joint return, you can exclude up to $500,000 of that gain. And married filing separate it falls back to the $250,000 exclusion as well. So what that means is, let's say that you're married filing a joint return, you sell the house, you've lived in the house for, say, 7 years, you've used it as your primary residence for that entire 7 years, and now you sell it and you recognize a gain of $400,000 on the sale of that house. Well, since that gain is under $500,000 and you're filing a joint return, the $400,000 gain vanishes. It disappears. You do not pay any tax on it. It is not deferred down the road. You don't have to roll the money into a new residence. Some people think that they've got to buy a new house or something. That's a very old rule. You don't have to do any of that. It just disappears. It just goes away. Now, the way that the cliff works is that you have to sell that house with, live in the house for 2 out of 5 years. So what happens is sometimes people will live in the house for a period of time, and then they will rent it out. And I have a client that's currently running into this. They've rented out the house, and basically, they have 3 years period where they can rent that house out. And then once they go 1 day over that 3-year period, the look back rule for the 5 years means that they no longer qualify for the 2 out of 5 years because they've rented it for more than 3 years. So the way that the math works is that it doesn't work that way. And so the day that they go 1 day over that 3 years of rental period and they no longer can qualify for the 2 out of 5 years, that whole $400,000 immediately becomes taxable to them, even though they missed it by 1 day. There's no proration or anything like that happens. And so it's something that you want to pay attention to. If you've lived in a home and then rented it out, you've got that 3-year period where you want to get that home sold so that you don't have to pick up that income. And now we talk about the basis of that house. So what basis means is how much you paid for that house plus whatever you've put into that home since the time that you bought it. So let's say that you bought the house 20 years ago for $300,000. Like good luck finding a home for $300,000 nowadays, but 20 years ago it was very possible. So you bought the house for $300,000. It doesn't matter if you financed it and used a loan to pay it. It doesn't matter if you paid all cash. Loans don't matter at all. Loans have nothing to do with your basis. Your basis has everything to do with what you bought the house for, whether that was with debt, cash, or whatever it was. So you bought the house for $300,000 20 years ago. Then let's say that over the period of time you put in a new kitchen that cost $20,000. You put in new bathrooms that cost $20,000. You put in a new driveway that cost $20,000. Let's say that over the period of that time you put in $100,000 into that home. Well, that means your basis has gone up. So you paid $300,000 to start. You put another $100,000 in, so your basis is now $400,000 in that home. Which means if you're filing a joint return, you can sell that home for up to $900,000 and not have to recognize any of the gain and pay tax on any of it because you've got that $500,000 exclusion. So that's something that we oftentimes look at with people when they say, hey, I'm selling my home. We say, okay, great. How much are you selling it for? They'll say, well, it's worth $1 million. Say, okay, well, how much did you pay for it? They say, well, I bought it 20 years ago for $400,000. And then we'll say, okay, well, what improvements have you done, and then they'll go back and they'll try to find the improvements or think through them. So that's the importance of keeping those documents, because if you were to be audited, the IRS would say, okay, we see you made improvements, where's receipts, where's some documentation or information on that. So you want to keep that information so that you can prove that in case of an IRS audit. But if you're within that $500,000 for a joint return or $250,000 for a separate or for a single return, then that automatically just disappears. That gain and the tax goes away. Like I said, there's really nothing in the tax law that just makes income and taxes just go away like that. When you own a rental property, you can sell it and do a 1031 exchange into another one, but that doesn't make the tax go away. That just kicks the tax down the road. With a personal residence, we're not kicking anything down the road. It just vanishes and disappears as long as you qualify for that. So those are things to keep in mind. It has to be 2 out of 5 years. Now, there could be a scenario where you live in a home for less than 2 years and now you need to sell it. It can't be that you just want to sell it. There has to be some kind of need. Something changed in your life that has now required you to sell that home. Maybe you've gotten married. Maybe, and you needed to move into a bigger house. Maybe you got divorced and you need to move into a smaller house. Maybe you had another kid and you needed to move into a bigger house. Maybe a kid moved out and now you need to move into smaller. Maybe you lost your job and now you need to move to get a new job. There could be a number of scenarios that happens, kind of life issues, life things that happen that require you to move from that home. If there is a life event that has requiring you to move and sell that home, the IRS does allow, and the tax laws do allow, for a proration of that exemption. So let's take the married filing joint. You have a $500,000 exclusion. Let's say that you lived in the house for a year. Now something's happened and you have to sell that house. You haven't met the 2-year requirement yet, but you've been in there for a year. So in that case, the IRS would look at it and say, okay, there was a life event that required you to move. We'll allow you to prorate that. So if you've lived in there for, say, half the time, they'll give you a $250,000 exclusion rather than the full $500,000. Let's say that you lived in there for 6 months and now you need to move. Well, they'll give you 1/4, so $125,000 you can take as an exclusion on a joint return, and then a smaller percentage or a smaller amount would apply to a married filing separate or a single return in that sort of case. And so there are provisions if you've got to sell your home sooner than those 2 years. So those are the rules when it comes to your primary residence and selling it, getting that exclusion. It's a powerful exclusion if you can get it. I say take it whenever you can. Watch the value of your home and see when it gets up to that. Now, another thing to kind of talk about on that as well is that, let's take the example back of someone that bought the home for $300,000, put $100,000 into it, so now their basis is $400,000. Let's say they sell their home for $1 million. How much gain are they going to pay tax on? Well, they still get the $500,000 of exclusion. So that $500,000 still makes it vanish. So now they're really only paying tax on $100,000 of gain. It would be a long-term capital gain in that sort of case, as long as they owned it for a year or longer. If they're getting that exclusion, they would have to have owned it for 2 years and lived in it for at least 2 years. So, let's say that it's long-term. So federal tax rates, they're going to pay 15 to 20% on that, and then whatever the state tax rate is. So let's say worst case scenario, they pay 20% federal, 5% state, so 25%. So on the $100,000 of gain that they have to recognize, they're going to pay $25,000 of tax, even though their gain is really $600,000. So $25,000 of tax on $600,000 of gain, not terrible, but it could have been better had they sold before their home value went above that $500,000 exclusion. So anyway, just something to keep in mind and take a look at there. And if you'd like to get more tax updates, then go to our website, taxtutor.com, and subscribe to our weekly newsletter.